Please, speak as you might to a young child or a golden retriever. It wasn't brains that got me here, I can assure you of that.
Another Saturday morning, and therefore another weekly market recap. Welcome back. So I'm gonna try to make it quick for real this time because I'm setting up a birthday party for my girlfriend, so I'm gonna be busy later on in the weekend. I know, in the past I've always failed, but you know what they say, right? The road to hell is paved with good intentions. So at least give me that. So in a nutshell, what happened this week? Well, we had a war which lasted 12 days. Then we got Trump saying he re-established peace, but after a few hours, the two contenders were again throwing missiles to each other. So Trump got a little bit angry and he used a tone which wasn't very institutional. Then, of course, we got again Trump calling Jay Powell stupid because he doesn't want to drop rates, although pretty much even in the mainstream media now, the general consensus is that it could be time to drop rates a little bit. And even in, among the FOMC members, there were two, I think they were Bowman and Waller, which came out saying, well, maybe we could, right? Instead of waiting till the last hour, as we always do historically, this time maybe we could be a bit more proactive. Maybe we'll see. In a nutshell, a little bit more of the same. I think they're gonna screw it up again. So in all of these, no matter all the bearish, porn, and doom and gloom talks, the market just climbed the wall of worries, and we got a good risk-on week, right? We've seen the stock market going up, we've seen gold dropping, we've seen oil getting back really, really lower compared to where it spiked. So all the geopolitical premium actually evaporated on the news that the war was over, right? And then we got the DXY kept on being weak. So everything is cool, right? Even Bitcoin actually rebounded. So, in a nutshell, if you don't want to stay any longer, this is what you need to know. Okay. For all the others, which are gonna torture themselves, let's jump into some charts right away. Okay, so let's have a look at the DXY. As anticipated, we started out the week on Monday and we just dropped all week. We just dropped initially and then we kept on bleeding lower. Now again, I've been a little bit skeptical on the DXY, keeping on really going down. It might come a point where it actually rebounds, but at this point, after 2 weeks of looking at some potential setup or signal and not seeing it unfolding itself, I mean, it's just one of those things, right? When you're wrong, you gotta say you're wrong, because even being too early in whatever type of analysis or trade, at the end of it, it's equal to being wrong. So, right, raising my hand, not happening for now. I was kind of eyeballing that. It's not happening. I think the fundamental premise is still there, but the technicals are not confirming it. And at the end of it, whatever trade, whatever asset you are engaging with, your P&L is going to be dictated by price action. So you can't really force your own ideas on the market up until the point the market actually confirms what you were thinking. So in this case, for instance, it would be maybe possibly with the underlying premise in mind, you could then wait for price actually doing something like this, right? Confirming a little bit of a bullish momentum or a shift in the current bearish momentum. And at that point, you might say, you know what? Now that price is confirming it, I got the fundamentals behind it, and I'm not going to get into it once again, right? That the sentiment, the positioning, all the doom and gloom about the dollar demise and whatnot, right? And maybe then at this point, with a little bit of confirmation, you could say, okay, this might be a setup which is actually unfolding itself this time for real. But up until that point, you just, the market is always right. There's no other way around it. So again, the dollar just drifted down a little bit more, and we got into almost the mid 96 at this point. So we'll see what next week will bring. And at this point, you just go with the trend up until the trend actually shifts in another direction, right? So as for the other majors, of course, we've seen the euro keep on being strong. Same for the pound sterling. The dollar Canadian, it pulled back, and actually at the end of it, throughout this week, it put together a bounce. The Swiss franc, it keeps on being strong, although again, it's always the same talk. Interest rates differential, the S&P actually dropped rates down to zero, talking about going negative, and nonetheless, the Swiss franc, it's still particularly strong against the dollar. So still a little bit of a flight to safety component into it, but most likely not really generalized to the overall market so far. So we'll see. And we still have this sort of divergence in between the yen and the DXY. So another thing which could, I mean, for now, it's not really generating any relevant moves, but just keep it on the back of your mind, highs. It could be relevant maybe next week, maybe next month, who knows? It's just one of those things. Again, just wait for it to actually generate some actionable signal, right? It's just a discrepancy, right? I don't like discrepancy and anomalies. It's always something that you should consider. If something is not moving as expected or as the logic would suggest, just mark it off. You might be glad you did. Maybe next month or 2 months down the road, especially when it comes down to macro, right? As for the other currencies, even in here, not a major revolution and no major surprises. The Indian rupee rebounded a little bit after showing weakness or being weaker relative to the rest. The Brazilian real kept on being the stronger, and we got the Australian dollar actually rebounding a little bit and getting back into resistance. Now we'll see if this time, right, it was grinding into it. Now we picked up fresh liquidity to the downside and we reapproached the resistance once again. So we might see if this time is the good one for a break to the upside. Okay. Now let's move on to another market where I was kind of wrong. It depends on how you see it. I guess I kind of was, to be honest, with myself, which is Bitcoin. So do you remember we said these level now it starts to look a bit weak. So if we tap into it once again, we might drop into the mid 90s. Well, didn't really happen to be fair. I mean, we just wicked down to what 90, 98, and it immediately rebounded this week again on the news that there was no World War III, there was no open conflict in between the US and Iran. It was just a one-off. So again, risk on assets. They just kept the ball and run, I guess. Right? What's next? Still, we are not making new highs, or at least we are not taking out the nearest relevant high, in my view. It looks like we're gonna try to. So I think, at this point, it's kind of like the same for the Aussie dollar, right? We picked up liquidity to the downside. We filled in this inefficient price move to the upside, although we didn't really retest the lower shelf. But nonetheless, we found a few baits in here, enough to propose these market higher. And at this point, I think, we could just target this high and then we'll see. Okay. So other than that, if you look at it from a closing standpoint, it's just ranging, right? So ranging and consolidating at a higher level after putting in a low and rallying off of it, it still favors the bulls in my view, right? So for now, nothing else to say really. You just can watch these highs, see if it gets taken out, and then price can confirm some sort of a bullish uptrend. And you can move your invalidation point for protracted downside risk to this low, which, at this point, I think there are good odds this is going to be probably the June low, right? Because, yeah, June started in here, so you got June's high in here, and the odds that it's going to be the monthly low at this point should be reasonably high, right? Gold, again, another one where I was kind of wrong, or at least I was proven wrong. So after a little bit of a drift to the upside, we tapped into the highs once again, didn't have follow through. So last week we left it bouncing off of support, didn't have any type of reaction this time around, as you know, as it was in here, for instance, 2 weeks back, and we just dropped. We had another tiny bounce at the previous level, but it was quickly faded over the next 2 days, and then again, risk on scenario, gold just sold off once again. Now, if you do like trend lines, we are retesting these upward trend line, which is going on since basically the end of February. Then it was retested at the beginning of April, sorry, and then it was retested in the middle of May. So if you do like trend lines, you could start to look at this as some sort of a consolidation or reaccumulation, because then again, if you draw a line like this, could start to look like an ascending triangle of some sort, and therefore up until the point this structure is intact, we still have a little bit of opium to go to the upside. Maybe, maybe not. I think again, as I said, if we lose the current momentum, and I think this is going back to maybe a month ago, where I was kind of reminding people that, it's not unusual for gold to stay in a choppy consolidation for a while. And I was highlighting this price segment right here, which went from basically the end of October 2024 up until the end of January 2025. So, I mean, it can happen. It's not like it didn't happen in the past. And, overall, it can still resolve itself to the upside, especially because, again, if you look at the fundamentals, they didn't really change, right? So I think gold, the bulls are not yet defeated completely. My point of invalidation for the short-term momentum on a bit more of a macro scale would still be the monthly low. So the previous monthly low for the month of May at this level right here. We we took the highs? Yeah, we took the April highs as well. So I mean, up until the point we are leaving lows intact and actually taking out previous monthly highs, I should still be, on the bullish side overall on a macro scale. The trend is a trend at the end of the day, kind of like with the DXY, right? So in this case, it is reverse. So we'll see about it. Just, if you want to kind of try to draw a parallel in between the two, so gold and maybe the DXY, they should trade inversely, as the logic would suggest. So if eventually you got that spike to the upside into the DXY, you might see a little bit of weakness into gold as a result. Could be temporary, maybe, but I'm always trying to think ahead of times, and let's say kind of figuring out the potential risk and making out the connections, or thinking about the potential links. Like, it could be the dollar spikes to the upside, gold it's sold off because it is some sort of a liquidity event, even if it is on a smaller type of scale. And then what's next? Do you have the dollar actually just being faded and gold catching a bid? So at that point, in a liquidity event of some sort, that would be your buying opportunity into gold, because it gets liquidated when everyone is scrambling for liquidity. But after that, usually and historically, it catches a bid. So I'm trying to think of potential future scenarios, so to speak. But for now, gold, I would. I mean, again, I'm not huge on trend lines. I would prefer. I usually rely more on horizontal support and resistance, but work in the past, I guess, or at least in the recent past. So who am I to say no? So let's have a look at this trend line, and let's have a look at the lower horizontal levels, right? Uh, let's say neutral up until the point we don't resolve this situation right here. And how? I mean, we could just see it keep on going down, bouncing, being faded at the trend line and the previous level which was broken, and keep on going down toward lows, right? So if you extend these out, you would have the break of the trend line, the break of this level, the retest of both, and continuation down, or the opposite would be kind of reclaiming the structure right here. Of course, it doesn't make sense like this, right? you would have to redraw it, but you got the gist of it. So bouncing off of here, getting back into the previous range, and again keep on being particularly stable above it, and eventually in time trying to reaccumulate and push to new highs. So this is basically where I am with gold, kind of in a limbo up until the point we don't get new price informations. All right, let's move on to oil. Again, an oil major scare. Oil, it's set up to go into the 90s and to 100 and, to the moon and beyond. Or at least that was it just last week. They were just talking about potentially bombing Iran to dismantle the Iranian nuclear program. So the US is getting involved. So it's going to be all out war. Oil, the geopolitical premium on oil, it's going to skyrocket into the 90s and beyond that. Okay, so where is it right now? You see, you remember it was 2 weeks ago. The title of the video was Oil Spiked. What do we do? Do we keep our cool or what? It was something along those lines, anyway. So at the end of it, again, even the geopolitical premium on oil just evaporated with the news that, again, it was a one-off. We don't want to engage in a prolonged fight with Iran. It was also a bit comical. Like, we are gonna say that we're gonna attack these nuclear facilities, but we are telling you like 2 weeks ahead of time, so you have the time to move your enriched uranium somewhere else. But at the same time, when you retaliate, right, you're gonna tell us like 1 week ahead which bases and in which region you're gonna target, so that we can then take down the missiles with our what was that, Iron Dome, whatever the fuck, and we are gonna call it a draw. And so our own propaganda in the West will be that we dismantle the Iranian nuclear program, and your own propaganda there in the Middle East will be that the Ayatollah regime, it's strong, it resisted the US attack, and actually it responded. Okay, and nothing really happened, but yeah, we both wins. And even Israel wins, right? It's just I don't know. Or maybe it's just me because again I'm not an expert on these topics, but to me sometimes it doesn't make sense. So sometimes it looks a lot staged, right? It's just like watching a movie. It's scripted or what? But I mean, anyway, I'm not cheering up. It's not like I'm a war hawk or whatever. Oh, I'm actually much more happy if you don't have an escalation in the Middle East, especially because as a European, we get a lot from that infamous Strait of Hormuz, so I wouldn't like to see it closed. Again, but at the same time, I can't help myself by laughing to some degree. Now, a brief touch since I just mentioned it on the Strait of Hormuz, right? Because that was another one of those boogeymen. They're gonna close the strait. Inflation is going to skyrocket. Energy will be capped. We're gonna have another energy spike, an energy crisis. And it's not in the distant past. The energy crisis that we got in Europe after the Russian-Ukrainian war. It's just 2, 3 years ago. So people still remember that. But when you start to look at the costs benefits analysis, who was nobody really wanted the Strait of Hormuz to be closed down, right? Let's have a look at these, for instance. So I mean, you can just read it if you want, but basically closing it down it was a lose-lose situation for all the parties involved, right? For Iran itself, because they would have lost a lot of a substantial part of their revenues and therefore a good impact on their GDP. Uh, the international community, so to speak, would have been a bit upset, especially China, because if you look at the chart below, you see that a lot of oil which travels to the Strait of Hormuz goes to China. And in the region, the Saudis would have been upset because a lot of the oil that they export, it travels throughout the Strait of Hormuz. So in the end, no one, I guess, really wanted, or at least, no one had anything to gain from it. And, again, with my very low skills in geopolitics, it might be the reason why, the fear was if the US are going to bomb Iran, you're going to have the Chinese and the Russians to respond immediately because they are allies. Okay, they didn't say a lot, it looks to me. So maybe because China had a little bit of a skin in the game, so it could have been okay, just drop a missile on those bases if you want. But up until the point you don't close the Strait of Hormuz, we are kind of cool with that. So we're gonna make sure that this thing, I mean, as far as we can, whatever we can do, you know, in our capacity, but we are not gonna add oil to the fire, right? No pun. Because we are interested in having this trade actually being up and open. All right. So again, it could have been another way of looking at it and assessing the potential probabilities of the strait being closed down, that for oil prices keep on spiking and whatnot. The bottom line is oil just dropped back into this previous range, so below the previous resistance again, but at the same time we bounced off of the previous low resistance, which now was flipped as support, at least for the time being. um, we might have a little bit of a ranging behavior for a while in oil. I mean, we got this spike in volatility, so by design volatility should expand and then contract. So maybe, unless we got any other negative news out of the Middle East, it wouldn't be unusual to see it cooling off a bit and maybe not going anywhere really for the next, I don't know, 7, 14 days. Would be cool, I guess. So we'll see. Levels to the upside. I mean, at this point, I guess again, it's pretty. If it's trading in this range, right? If it breaks to the upside, we might have another tiny bounce into the 70s, maybe, right? If it breaks down, we might see oil getting back into the 60s, low 60s, right? So that would be my general assessment. But even in this one, it's kind of like with gold, up until the point it stays in this very contracted type of price action. I'm, I'm neutral, right? So we'll see about that. Now, before moving to bonds, yields, and the equity market, let's have a little bit of a brief pause. Just 2 seconds. All right. Having a look at the yields for this week, what we see is that they basically came down a bit. Again, could be tied to the oil market and therefore the inflation expectations now that oil actually tamed itself down. I was looking at this because I thought it was just interesting to bring it back up. I talked about it in the past. It's just something that if you have never stuck your nose in the bond market, maybe you don't know, but it's a phenomenon which could be useful to know, especially if you are engaging with this particular market. Now, as you can see, I highlighted the drop, or at least the percentage move from peak to trough, so from the wick to the upside, and the recent lows. So these local high to these potential, we'll see, it's not confirmed yet, but potential local low for basically all the duration, right? So you got your 30 years, your 10 years, and your 2 years. So what you see is that basically the yields on the long end of the curve, they came down a good 7.04%. On the 10-year, they came down 8.36%. And on the 2 years, they came down 8.71%. So again, the the short end of the curve, it's coming down faster than the long end. Therefore, that should be your bull steepener, which is not good, by the way, overall. It's not a good signal in macro terms. But then when you look at the underlying asset, what you would expect is, okay, so, the long end came back down a bit slower compared to the short end. So I would expect the underlying assets, so the relative assets, so the 2-year notes, uh, actually, for the inverse relationship, it went up a bit more than the 30 years bond. Because, if I just look at the yields, right? But then you check and you see that from the same trough to the current peak, let's call it, the 30-year bond futures went up 4.77%. The 10 years, they went up 2.46%. And the 2-year note futures just went up a silly 0.64%. So you might be scratching your head thinking, that doesn't make sense. I mean, the long end came down a bit more. Why, the underlying asset, it went up way less compared to the long end, which, as for the yields, it came down a bit less. So what's going on? Well, what's going on, as stated in the past, is this: the bond convexity function. So again, you can just read for your own what it means, but basically, in a nutshell, in words that even I could understand when I first read it, the the relationship, it's not linear when it comes down to the movement, to the corresponding movement in the underlying asset price relative to the movement in the yield. All right. And why is that? It's because of duration, basically. So again, if you want to read that out, it is just Wikipedia. By the way, it's not some secret info that it's hidden in some strange place on the internet, right? And if you are a bit more skilled in math, which I'm not, you can just look at the formula and see if it makes sense for you, right? But just for the sake of it, I wanted to reiterate that a little bit. Now, before leaving the bonds and the yields, there have been a few, I don't know if you could call it news for real, because it's just a proposal, right? It was long telegraphed, so I mean, we knew about it for the longest time now. Now it looks like the proposal. Let's put it this way: it was just talks before. Now it looks like a bit more an official proposal. I'm talking about lowering the SLR metrics for the GC banks and for other huge commercial banks. What does it mean in a nutshell? I'm sure you can just Google it and you could find a bit more of a in-depth insight into it. But it means that if you lower the SLR, which by the way, it's the supplementary liquidity ratio, it has to do with the balance sheet or the balance sheet structure of a bank. If you lower that, it's basically like saying to a bank, you know what? I'm allowing you more space on your balance sheet because I'm decreasing the amount of reserves, so to speak, or the amount of liquidity, as for the acronym, that you need to keep on your balance sheet in order to, I don't know, maybe be solvent, since, we are operating on a fractional reserve type of system. So to some degree, if you are negative on this topic, you might say they are allowing the banks to take on more leverage, so to speak. But anyway, whatever, it doesn't really matter where you are on this argument. What matters for you and for me and for us is that this is what they are proposing. So allegedly, that would leave out more space onto the bank's balance sheets to buy up some other assets, right? And what could ever be in the mind of the regulator? US Treasury bonds. And why is that? Well, if they buy more, they're going to contribute to lower the yield. So when then the government actually have to refinance all those trillions of debt which are coming due this year, the government will be allowed to do it at a much lower and favorable rate. Win-win, right? The banks win because they, whether you believe it or not, they were actually moaning about these supplementary liquidity ratios being too high and therefore constraining their abilities to do business. So the banks actually wanted it. The government at this point, why shouldn't it? Why should it say no? So looks like this is something which everyone wants. Maybe not me and you. I mean, everyone's gonna have his own opinion, but nonetheless, it might impact the future movements in the bond market and therefore conversely in the yields. Now, I'm not saying this move to the upside that we have seen this week in the bonds is all due to that. Again, as I said, I think it's mostly due to inflation expectations being repriced a bit lower, no matter if Powell said that it is not in a rush to lower rates, but that's what happened. There is another thing that I found. I mean, I'm not gonna tell you what it is in details, but I'm gonna point you out to where I found it. It was on Joe Brown channel on YouTube. This one right here, right? Heresy Financial. So basically, in a nutshell, if you don't want to watch the video, which by the way, it's just 11 minutes, so I would watch it if I was you. But they are also planning to stop the Federal Reserve to pay interests on the reserve, the bank reserves that they issued, and they then put on the bank's balance sheet. All right. Does it mean something substantial? Well, you could argue as it does. I think, again, I would be in line. I would be in agreement with that. That if you don't pay them the interest, which again, it's not really Fed funds, it's IOR, interest on reserve, right? If they don't have an incentive to keep those reserves on their balance sheet because they're not yielding them nothing, they might just drop the reserves, getting them back to the Fed, taking back out from the Fed balance sheet the quote unquote money, and then spending those money or allocating those money somewhere else where they are getting a bit more of a yield. What could these be? Should be something which is liquid, which is not that risky, but still grant them a bit of a yield. Wait, T-bills, right? And what the government needs to issue more debt. And they want to issue at the short end of the curve so they're not locked in a debt at a higher interest rates as a burden, which are going to bite them in the ass for the next 10, 20, 30 years. So why not T-bills, right? So again, I think the logic is kind of sound. Oh, I don't agree with everything which is stated in the video, but it's a good one nonetheless. At least for it could spark the conversation or potentially your ideas or your train of thoughts if you want to. Um, a little bit of an aside. I guess now that I'm watching it, my girlfriend is actually right when she says that if it wasn't for this financial bullshit, my YouTube feed actually looks like a teenager YouTube feed. I got video games, I got tech, I got a bunch of stupid bullshit on this one. Of course, I got European football, or AKA soccer for the Yanks. Yeah, I mean, but enough about me. Let's get back on track. So again, this could be two or three things you might want to consider over the coming weeks and months. And then, of course, we got what? We got Powell again in the news testifying to Congress and going a little bit like this as anticipated in the brief overture at the beginning of the video. So he said basically the same. He doesn't really see a huge risk for the economy. He doesn't really see a huge risk for the labor market. And again, he's still scared about potential tariffs generated inflation. So bottom line, it feels like it doesn't need to be in a hurry, right? But again, we got now two members which are publicly concerned of the job market. So again, these are just a few quotes from Bowman and Chris Wallace. So just take it for what it's worth. I think, at the end of it, uh, he's the Fed chair, so I guess his vote counts more than anything else or anyone else. But surely, with all the uncertainty, getting to a decision which is not supported by some sort of a unanimity could actually throw a dent in the Fed credibility, as if they need it, right? I mean, their credibility is just bullshit because they always screws up, and they never got anything right in the history of their institution. So maybe that's not what they want. Speaking of which, this is basically what what the Fed is looking at, right? The problem is, as is stated right in here, is that they are kind of taking on decisions now based on the ghosts of a quote unquote mistake they did in 2023 and 24. Do you remember the whole thing about inflation being transitory and then it wasn't? The problem is that in macro terms, it was transitory, right? If you think about it, it was just a supply shock. You locked everyone in a cage, you shut down supply chains globally, and then you just helicoptered money to everyone. What do you think is going to happen? You're going to have inflation. Is it sustainable? Well, if those stimulus are going to wear off, and people are gonna get out of home at a point, and supply chains will be brought back online at a point that supply demand imbalance is going to be resolved. So it's not really an underlying structural inflation premise. But again, even in here, the Fed said it was transitory. And again, they were right. The problem is that they went down the rabbit hole of being kind of captured by the public opinion. Because for me and you, for the men on the street, when you say transitory, we are thinking about maybe, okay, it's going to be a month, probably next quarter, everything is going to get back to normal. Then when you realize it's been a year, inflation is still high. It's been almost 2 years now, inflation is still high. These Muppets, they didn't know what they were talking about. So the Fed needs to kind of bend the knee to the public opinion. Otherwise, again, the credibility, and since credibility is all they got, they need to play ball, right? But again, one mistake leads to another, because now, since they were called wrong, even if they weren't, on the transitory inflation, now they got the inflation boogeyman in the closet, and every time they think about lowering rates, they are always worried about a potential renaissance of inflation due to tariffs, which again, historically, they have been proven to be more disinflationary or deflationary than not. This is another Fed chair conundrum. We got, what was it? We got Greenspan when he was talking about, no, it's too long of a topic, but at times each one of them fell into this type of conundrum. You got Greenspan and then Bernanke, and even the hero, the legendary Paul Walker. The myth of Paul Walker, it's just bullshit. It was just another one of these technocrats which didn't know what he was doing. At the end of it, inflation came, inflation went out, but it wasn't because of Paul Walker. I can tell you that. Just try to go deep into the topic on your own if you don't trust me, right? So this is basically the mistake the Fed did, right? Because we got the amount of stimulus in red skyrocketing, therefore inflation year over year change skyrocketed. Sure, GDP, but it just followed the stimulus and inflation, right? And look at Fed funds. Assuming it really serves a purpose, which it doesn't, right? But they waited to start hiking rates up until the point inflation was at the peak. Ironically, when they started hiking, inflation peaked. So they were behind the curve back then, and probably they're going to be behind the curve right now. So this is the Fed, right? A good use, I guess, of those hundreds of PhDs they got. So if you check a few historical related type of events, you see that you got a few inflationary episodes, and you got you know the final outcome off of them. I don't feel particularly qualified to talk of World War II, or at least past World War II, after World War II. But I can tell you that I don't fully agree with this 70s stagflation problem, and especially I don't agree with that. Again, as I hinted at, it wasn't until Paul Volcker aggressive interest rates hikes that bullshit, right? Just for me, it's straight out bullshit. This Paul Volcker myth. It's another myth. It is actually the myth on which this whole idea that the Fed is at the center of the monetary system was built up upon. And if you check history, they screwed up ever since, every single time. So again, don't trust these narratives. Then you got the inflation boogeyman of Greenspan in the 90s, right? Was scared about the dot-com generated inflation, and then the dot-com crashed and everything got to be deflationary once again. And then you got, I mean, if you need any other type of evidence, after the GFC, they allegedly flooded the world with money, QE infinity, money printing going burr, and what they got for the next 10 years was they couldn't get inflation to the 2% target. We were always below, kind of, and at least on average. So again, they were wrong then. Most likely they are wrong now. And if history is a good teacher, they're probably going to be wrong in the future, right? Now, this is interesting because I was having this conversation just this week, and I think, this is just some sort of a recap of what the Fed has done since it was established. You can just have a look at it if you want. For me, the point on this chart we deserves to be highlighted is the top. So the distinction in between the pre-World War II era and the post-World War II era. Because I've seen, and again, I'm all for sharing informations and opinions, and I do agree that oftentimes, majority of the times, I'd say, when you got a huge and extended, especially extended backward in time type of data set, it's useful to have the biggest the data sample is, the better statistically, right? But I like this distinction in here because if you think when you are comparing what the Fed did before the 50s or before World War II, or what the outcome was, right? Especially at the beginning of the century, and then you try to compare it with what happened after World War II. I think honestly, and again, I don't mean to shit on anyone shoes. I don't mean to be rude, but I just think you are comparing apple to oranges. What the Fed did before and what it did after, I, I think to some degree it cannot be compared one to one because the monetary system was different. Up until World War II, the dollar it wasn't the global reserve currency. We were still looking at the British pound. Now, sure, maybe the British pound it was just at the end of its cycle. Probably it would have gone away anyway. The war was just a catalyst for it. Totally agree. But the point is that you cannot compare decisions that have been taken by a monetary institution when the underlying thing that they are supposedly managing and running was one thing before and it became a whole different thing after it. So if there is one takeaway from it, I would think is this one right here, right? As for the rest, it kind of reiterates all of what we were discussing so far. Uh, this is again just some sort of a recap. If you want to look at the relationship in between Fed funds, the 2 years note, how the S&P responded, and interest rates. I guess this should be what? Yeah, Fed funds, 2 years note, sorry, yield, and the S&P. Yeah, so I mean, again, if you want to check it out, it tells the same story, so I'm not going to spend a lot of time on it. We are now looking at this, right? So the oh, wait, do we already check this out? Maybe not. Now we are looking at an index, so a composite index of economic output against inflation. So it's just to reiterate the fact that maybe, just maybe, there are a few evidences which are suggesting that the economy is in contraction. It's not in recession, right? It is just slowing down. It is just contracting. So maybe, just maybe, keeping rates so high, it's, maybe it's not the best advice ever. Unless, again, you want to wait up until the next moment. You want to really get to the point where you see the labor market collapsing. And at that point, you run for the hill and you just drop rate from, I don't know, 4.33 where you are now down to 2% in a matter of 6 months, which is basically the Fed panicking at that point. This is the risks, right, of being wrong again. If you just look at this, and again, does it mean it's gonna play out exactly like that? Does it mean it's gonna play out tomorrow? No, but it's just, I guess you can't say you're data dependent and then ignoring the data, in my view. But then again, I don't run the Fed, thank God. I can only react to what they do. And ultimately, whether we like it or not, the market, one way or the other, is going to look at what they are doing and it's going to react to it. So all these macro talks at the end of it, they make sense academically, but and then when you day trade this shit, the market is going to do all the crazy moves you can think of just because these puppets are telling one thing or the other. It's just a knee-jerk reaction, which gets you more often than not. So enough of that. We shit on Powell last week. We just reiterated what we did, what we said, because he reiterated what he said again. So moving on to stocks. Before that, I just forgot. Just have a look at the economic calendar, or at least the most relevant news for this week. So again, what we got, home sales. They came in a little bit above expectations, I think, if I remember correctly. Yeah, I mean, yeah, 0.8, it rose. So again, and bear in mind, we're talking existing home, right? Even month over month, we got a little bit of a rebound. So again, what you might infer from it, the real estate, the housing market, it's solid, right? Well, maybe it's a little bit more stagnant, but it's solid. Then you get to the new home sales, and it tells you a different story over the same period of time, right? This one is not good, obviously, because it just plunged 13.7%. So, I mean, I guess it's not the best. And month over month, again, kind of the same story. Now, I don't touch a lot on the housing market usually, but I think, at the end of it, given my poor understanding of it, I would put a bit more of emphasis on the new home sales, right? Because I'm just looking at that through the lenses of, okay, so new home sales have been built up. In order to build them up, or at least, the constructor, it needed to pay the workers, pay the materials, pay for all the bureaucracy involved in actually building whatever these days, right? So if they don't get to bring it to market and sell it out at a profit, that's not only a problem for the housing market in general, but for all the people which are working or are tied to it. It's like when you see a company failing earnings, right? Or starting to having contracting revenues. At a point, if those margins are squeezed, you're going to do what? You're going to cut jobs. Uh, the same could apply to the new home sales. Because again, existing home sales, it could just be a citizen selling his house to another. Is it good or bad? If that happens more or less, I mean, yeah, you can be the judge of it, but at least, let's say I want to sell my house, but I don't find a buyer. I'm gonna be stuck with my house, but I'm not gonna lose profits and having to fire maybe 100 people, right? So my personal impact on the overall economy will be way less compared to what the phenomenon might bring as for the implications when you look at new home sales, right? So that was just call it rationalization of it if you want, right? Then of course we got GDP numbers, which was negative. Um, is it the end? Are we in a recession now? I mean, technically, you would need two consecutive quarters of contraction in GDP to say we are in a recession. But we've seen in recent history that even that can be disputed, and you can just change the definition as the Biden administration did, or you can just say, well, okay, that is the classic definition, but we are the government, so up until the point the NBAR is saying we are in a recession, we are not counting it as such. So all is rosy, stop moaning, go to work if you can, because the economy is great, right? I mean, again, we've been talking a lot about the potential discrepancies in this data given by the front running of tariffs, the inventories being built up, and all the rest. Uh, it was no mystery that something was contracting, especially when you were looking at the labor market. But this is maybe just proof that something actually contracted. Now, I don't have the chart for it. I was just listening to a podcast from Davey Rosenberg on Macro Voices, and he was claiming they as a fund they got access to month over month GDP read independently from the establishment. So the what was that? The BAA, Bureau of Economic Analysis, I guess. And they were looking at a month over month contraction in GDP, which is going on for 6 months. So in his thesis, GDP is contracting not this quarter, but it started contracting basically last October. But again, he got the data for it. I don't have access to it. And quite honestly, he's been particularly bearish on whatever over the last 2 years. And as we've seen, markets just shrugged all of that off and they kept on rallying after the tariff shock on Liberation Day. So that is the problem with the relationship in between macro data and then markets behavior, right? It takes a lot of time for the market to get back in line with the macro realities. So just because the data are what they are now, it doesn't mean that you can just go and short everything, right? GDP now, it's now forecasting for Q2 2.9%. Yeah, I mean, I already told you that these forecasts right here above 4% were particularly optimistic. I'm not saying it's going to be negative, but again, assuming a rosy picture, maybe it's going to be around 2.3, 2.5. I'm not seeing it going a hell of a lot higher than that. And God forbid, now we got talks about the big beautiful bid being a bit stuck in between the House and the Senate and the reconciliation process. I guess it could. I don't think I heard anyone talking about it, but that could be another risk for the markets. I'm not, again, always remember, I'm not cheering for one side or the other when it comes down to political games. But I just think if you cannot pass that bill, what's going to happen? If those tax cuts are not at least extended, you get back to the previous tax rates. Does it mean taxes are going to go up on the citizens? That would be a drag on the money available for consumption. So less consumption, less corporate revenues, less earning growth, less earning growth. So maybe failing and missing expectations, stocks need to be repriced lower. Because at the end of it, it's always the same. The market, it's going to beat these stocks higher on the expectations that earnings will be higher into the future. So they are paying a premium now for something that they expect into the future. If for whatever reason this something never arrives, they're going to reprice the stock lower because they just realized they overpaid for something which won't most likely won't deliver. So again, I think even the big beautiful bill, assuming it gets stock, it could be a little bit of a branch in this never-ending rally in the markets. But again, we need to see how it's going to unfold itself. Um, I hate politics as much as the next guy, but for one reason or another, these things could and potentially will move markets around. So although I don't like it, to some degree, I need to follow it. All right. We got what then? The Chicago Fed National Activity Index. I think we were looking at this just last week. No substantial change this month, or at least nothing particularly eye-catching in my view. So I didn't make a lot off of it. Initial jobless claims, they just well, I mean it's not like they topped out, but they came in a bit lower compared to the previous rate. So maybe not that bad up until the point you look at the 4-week average, which is still going to the upside, and you look at the continuing claims. So people which just went onto the unemployment line and for some reason or another, they can't find a new job. So they stay unemployed. And that's not particularly cool, especially over the last 2 months, I guess. So again, other signs that the labor market is maybe not rock solid, as Jay Powell would suggest. And this is where I was a bit like, what? Again, or disclaimer, could be just me. I'm not by any mean, and I don't have a PhD in economics, but if personal income just tanked like this, all right, and if personal spending just tanked like this, how do you reconcile PCE staying relatively stable to, should I say, with this one keep on accelerating to the upside? If you're worried of a potential inflationary threat, who could, who gonna fuel the you know inflation into the future if those which are supposed to fuel it are now saying less spending and less income? Now, Jay Powell said it's all due to sentiment, because they feel a bit negative because of the trade war and whatnot, so that they're just spending less. Okay, but they're also earning less. How do you square that out? I don't know. Could this be just another conundrum, or maybe we just ignore the hard data at a point? I don't know. But this again was another thing which, for me, it's proving that the odds of Powell being wrong and behind the curve as well, again, are particularly high in my view. So that was it for the econ calendar this week. Now, inflation expectations, as you can see, as for the break-evens, they remained particularly tamed. They got a little bit of a bounce on this oil spike, but not even that terrible, right? If you compare the spike in oil with the bounce in the break-evens, it's not that huge. So again, I don't see inflation coming in. Now, as for the July meetings, the market is now pricing in an 81% chance that rates will stay where they are, and they are still looking, the market, Still looking at September for a drop, a 25 basis points cut. We'll see about that. Could totally be. I think, again, we're just playing games, it's all speculation. But if you start to listen to people like Waller and Bauman, considering that you don't get to cut in August, would it be that terrible to just cut, I don't know, 25 basis points now, getting back to it in September and look how things shaped up and saying, you know what? Okay, 2 months, we cut 25 basis points, everything is cool, so we get back to pause, right? Or, we cut 20 basis points and the economy kept on softening over the last 2 months, so basically since July to September, next meeting, we need to cut another time. I think it would be much leaner. It would also potentially bring in less panic because let's say you don't cut now, and is it a little, is it a little bit of a deja vu right here, right? When they cut 50 basis points back then, right? Because if you don't cut now and then you get back to it in September, oh, we need to cut 50, 75 basis points or maybe one full percentage point because, well, I was just on vacation. I came back from my trip to the Caribbean and now I found the economy is down the drain. I need to run for the hill. That, I don't know. It does give the impression like you're now really panicking, and it just shows to the public that maybe the emperor were he not close from the start. So if the problem is always credibility, I don't know. Maybe I would cut. But again, that's just me personally. Let's finally bring back the stock market. As for the charts, let's see what happened. So of course, Monday we gap down because we bombed Iran, escalation and whatnot. And right off the bat, we start rallying. We rallied in Asia, we rallied in the European session, did a bit of a drop, and then again, the US session ended up with a massive rally, which was, brought up and brought on throughout the following Asian session. And again, in London on Tuesday, a little bit of a pullback and then up at the US Open. Stable in Asia, a little bit of a peak up below, and then up. This is where we were, at least I got massively bullish because we got the S&P basically taking out the lows, and NQ actually didn't. So at this point, it was just Wednesday. Okay, let's get ready for continuation of this rally. Lo and behold, you got another London session, which is all up, a little bit of a rebalance at the New York Open, and up it goes. Same on a Friday, London session is up, a little bit of a rebalance to the downside at the New York Open, and up it goes. And then we got a little bit of a pullback closing down the session. I think, and again, it might be just my speculation, I think it was because Trump said that he was ending up all the talks with Canada as for a few trade deals, especially the digital tax or something, which is something that is a point of contention even with the EU because supposedly Canada and the EU they want to tax US big corp, mega cap tech companies because they are allegedly gaming the, the fiscal system. Look, I've always been a bit on the fence. Don't really want to take one side or the other, but if you look at it, or at least if I look at it from the United States standpoint, I might say you are basically implementing no trade measures, you are implementing fiscal measures to actually cap the ability of my industries or companies to penetrate your market. But at the end of it, I think maybe the EU and Canada are the ones to blame. Because if you allow these companies to just set up an headquarter in Ireland where the fiscal policy is particularly light, or should I say fiscal pressure, then you don't get to moan if those companies choose right that spot to set up the headquarter and therefore paying taxes under that fiscal regime. Then again, maybe Irish fiscal regime it's still a bit higher compared to what they could get in the US, and maybe Trump would still be a little bit angry. But again, I see more discrepancies in what the EU is doing compared to what the US is doing. I mean, the US is clearly trying to defend their own domestic companies on the global stage. Uh, we are not in the EU. Not only we are not, but we are just drowning the private corporate sector with a massive amount of red tape, right? Massive amount of regulations, bureaucracy, all the bullshit you can think of. And then we moan because, someone else, somewhere else, it's doing things in a way which is maybe a bit more conducive for these companies to generate revenues. And we are blaming them for our own problems, which, again, to me is absolute stupidity. Now, we've seen basically the markets they kept on trading to the upside. Actually, the week was completely green, as you can see. Um, are we due for a pullback now that we established new all-time highs? Maybe it could be, but again, I don't see any real huge risk for markets at this current moment in time. They're grinding to the upside. A market which makes new all-time highs, it's hard to be bearish on it up until the point it gives you clear signs that you need to be bearish. It could be from here on out breaking this swing low, dropping back down, retesting it, and confirming a rejection. It could be maybe 3-4 months down the road, but at least wait for a decent price signal that things are actually changing around. And yet, what you see is YouTube full of fear-mongering stuff, bearish porn, and this is kind of the perverse mechanism why the more bearish these people are, the more I keep on being bullish to some degree. Because look, institutionals are still underweighted equities. They got a major scare, they de-risked, and now they started to short the market to hedge themselves. And those edges didn't really play out well because the market kept on driving on drifting to the upside. So at a point, they're gonna play catch up. Now, this sudden move to the upside this week, it was a little bit, in the cards because of the end of the quarter dynamics. If you want to show your clients a good report, you need to have in your portfolio the best performing stocks, right? So what's going to happen is most likely a little bit of a window dressing type of phenomenon, right? So probably a little bit of this buying pressure was coming in even from the institutional side of the spectrum. But look, the market just kept holding the 21 exponential moving average. We got now a wait, yeah, we got a golden cross. Do we have it? Yeah, I mean the 200 days actually got back above the 100 days moving average. To be quite honest, right on the spot, I don't even remember if the golden cross was in between the 200 and the 100, or maybe it was the 50 with the 200. Well, guess maybe before telling stupid things, I might just take it back and saying that at the end of it, regardless the golden cross or that cross, what sticks is that all these moving averages now are looking at an upward slope, and the market is going to the upside. Do we have a little bit of overbought condition, especially in the stochastic? Maybe, but I was having this conversation right to, yeah, yesterday, right? It was Friday, yeah. Whereas it was, look, I know sometimes you got some signals from the stochastic or any other oscillator which could be overbought, oversold. But just because you got this condition now, it doesn't mean the market can stay overbought or oversold for a much prolonged period of time. Markets can stay extended way more time than what your indicator would suggest. It's another good old cliche. Markets can stay irrational longer than you can stay solvent or whatever it was. So could we see a pullback sooner or later? Well, maybe. We also have now this gap to the downside. So, you might see the market dropping a little bit, kind of like pulling back. But again, up until the point we maintaining this posture, I don't see any real risk in the very short term, right? Uh, it's just the more people get bearish, the more I keep on thinking, you know what, I want to stay bullish these markets. Are there a few risks? Yeah, maybe, as I said, potentially the big beautiful bill getting stuck, or it could be uh, the exuberance that we are now looking at in the markets. Like, for instance, take a look at these. It looks like there is a huge amount of call option volumes accompanying these run to the upside. So again, it's some measure of exuberance. Yeah, okay, maybe. It never ends up well, sooner or later. The problem is that you never know for sure when that later is. So, and as I always say, you don't want to be the one playing the hero game and starting shorting the tops because you want to look fancy. Just wait for a top to be confirmed, and then you might think about hedging or shorting or whatever. But up until the point it doesn't happen, there is no point, in my view. Okay. Now we are getting into a new month, so let's look at the stats for the month of July. So this is comforting, right? It basically says that the stock have gained in July for 10 years in a row. So July tends to be a kind of a good type of month as for the returns. Now, it gives you all the data starting from the 30s. Sure, you got a few periods here and there where the returns were a bit subdued. Okay, but overall, July, it's a good month if you want to be long stocks. It tends to be one of the strongest months of the year, as you can see in here. Um, so we got what? Well, I mean, the green is the past 10 years, blue past 20 years, since the 1950s. It's only, I mean, if you look at the broader spectrum, it's only second to what? Um, April, March, and of course, November. But we know, at the end of the year, it's the strongest period. So again, my bias keeps on being particularly bullish on risk on assets, or in this case, the equity market, up until the point something changes. So narratives, bearish porn, the drama, the war, the end of the dollar, the debt. Sooner or later, something will happen. We are going to have some exogenous event. Nobody knows what's going to be, when it's going to be. It's going to be there somewhere in the future, right? It's going to be the usual thing that nobody saw coming. The markets weren't pricing it in, the usual and proverbial black swan. And at that point, with that catalyst, most likely, all the underlying cracks, as for the labor market, the economy slowing down, the global economy slowing down, uh, interest rate swap spreads being negative, yield curves being inverted. At that point, when you get that catalyst, that Bear Stearns or Lehman Brothers type of moment, at that point, all the underlying dynamics and fundamentals will become relevant to a much bigger degree. But up until that point, especially if, like me, you trade more in the short term, just don't be scared. Just discount all this noise, so to speak. And again, even if you trade with a bit more of a medium to long term oriented type of a idea or premise, think about the recent events. Think about this week, all right? We just bombed Iran. It's the end of the world. We just started World War III. Russia and China are gonna react. The Strait of Hormuz is gonna be closed down. You know what? Sell it all on Monday. Look, the market it just kept down. It's gonna be terrible. And then what? So again, the best thing to do when you're faced with a panic or unusual events, it's fucking do nothing. Just wait for the market to cool off a bit, make up his mind, and then you'll see what's going to happen. Don't overreact. Don't knee-jerk react. More often than not, you're going to be way better off in the future. Even if what you think is going to be the one, right, the black swan, if you look at past real big economic downturns, more often than not, you get your chance to the risk to mitigate your losses. You can always sell into a bear market rally. I think it's a far way better option than ending up, as the majority of the cases suggest, to puking the lows and then having to play catch up with a market which is ramping to the upside and you need to chase it higher and higher, decreasing your risk reward and increasing the possibility that just when you buy it, the market naturally pulls back a bit and you get back into that panic situation again. Fucking hell, I sold the bottom. Could this be that now I just bought the top? I need to get out of it once again. And now you're down for a double loss in a row, right? So bear it in mind, stay calm, keep your cool. We'll see about that, okay? Let the market be the judge of it, all right? And with that, of course, I'm sure by looking at the timer that I didn't fulfill the promise. I guess the video is already long, 1 hour and 15 minutes. So I'll leave you off, wishing you a very good weekend and a very good beginning of next week. Remember, next week, it's going to be a very short week. Friday, it's 4th of July, if I'm not mistaken. Let me double check real quick. Yeah, and the market will be closed early on a Thursday. So very short week. Three day and a half of trading for the market. And we're gonna have labor data next week. So, you know, ADP, the JOLTS report, and all the rest. It might be spicy a little bit, right? Just for the sake of it, what we're gonna have. ISM manufacturing, but I've seen the JOLTS as well. What was it? Thursday. Participation rate and NFP on Thursday, of course. But there was, I'm sure I saw the JOLTS somewhere. No, yeah, there you go. So again, ISM, jobs data, a lot of different things. Short week could be a bit spicy, right? So up until next week, as usual, be nice and be cool. Knees out.
Shit, this is really gonna affect people.
Yeah, it's going to affect people like me.
No. Real people.
Jesus, Seth. Listen, if you really want to do this with your life, you have to believe you're necessary, and you are. People want to live like this in their cars and their big fucking houses they can't even pay for, then you're necessary. The only reason that they all get to continue living like kings is because we got our fingers on the scales in their favor. I take my hand off when then the whole world gets really fucking fair, really fucking quickly, and nobody actually wants that. They say they do, but they don't. They want what we have to give them, but they also want to, you know, play innocent and pretend they have no idea where it came from. Well, that's more hypocrisy than I'm willing to swallow, so fuck. Fuck normal people. You know, the funny thing is, tomorrow if all of this goes tits up, they're gonna crucify us for being too reckless. But if we're wrong, and everything gets back on track, Well, then the same people are going to laugh till they piss their pants because we're going to look like the biggest pussies God ever let through the door.